Welcome back, everyone. And the book about the market panic is about the discussions this morning by Stephen Vines. And I'm reading just a very short paragraph here in the preface to Omotola Abimbola from Afrinvest, one of the investment analysts here in the studios. Thanks for sticking with us. Let me just read this very quickly. We were just talking about that before the break. Said, the basic certainty is that any market suffering a profound fall will often quickly enjoy a substantial recovery. It could even be said that market crises are almost designed as buying opportunities. Yet, much of the literature on investing is devoted to telling investors how to avoid getting burned at times of crisis. End of quote. Speak to that.
I agree with that submission. As an investor, you should know that volatility is your friend. You have to embrace it. Markets,
volatility to the upside or to the downside, or both.
They are your friend, and you have to take advantage of them. Let me give you an example. Warren Buffett is probably acknowledged as one of the most successful investors ever in the world. But in the early years of 2000, in the early 2000s, it was underperforming the market by a substantial margin because of the dot-com bubble. So he is not a tech investor. He invests basically in railroads, consumer discretionary, etc. But the techs were the hot things in the early 2000s. But he stayed away from them because he was very disciplined. However, what happened afterwards? The dot-com bubble busted.
Just less than 10 years after.
And over the long term, he has continued to outperform the market. So the key thing I'm trying to bring out of this is that as an investor, you have to be very disciplined. Don't get carried away during periods of boom. Have a disciplined approach to investing.
So if we look at the first major market boom, which I would say was 2005 and 6 and 7 to the first quarter of 2008.
Correct.
By this time, 10 years ago, we're looking at the Nigerian Stock Exchange, all-share index around 64,000.
Yeah.
Reading. And that was massive.
Quite massive.
Highest ever in about 50 years. Then if you look at the market euphoria, 10 years ago, or by this time, 10 years ago, before the downturn came sometime in March of 2008, do you think that there's a bit of that euphoria that was not well managed by the expectation of investors, in particular the millennium boomers who are investing majority for the first time in their lives?
Well, the exuberance in the market between 2005 and 2008 was global. It wasn't just related to Nigeria. And you find a situation whereby companies with very weak corporate governance, with poor risk management structure, were being priced as expensive valuation multiple because of forward expectation of earnings and continued economic boom. But because afterwards we saw the markets crash, partly because of the financial crisis that occurred afterwards, and the fact that oil prices also nosedived. And Nigeria's business cycle is typically correlated to oil prices. So investors went away, and we saw the markets experience one of the worst returns in a very long time. But coming back from that crisis, I think the Nigerian market has actually, recovered quite nicely. Although we're not back at that peak yet, we have seen improvements in corporate governance standard. We have seen regulators step up to ensure that companies listed in the market are well regulated. They are adhering to corporate governance rules. They have timely submission of reports. And even the central bank, they have even done more to increase prudential regulation and guidelines for financial institutions who are very important in the financial markets. So
I don't think we've seen quite a lot of untooling and retooling. Yeah. In particular with the banking sector, because the whole market back then came on the back of the banks, as it were. Yeah. As we've seen the exit or the scrapping of the universal banking model. We've seen a recapitalization. We've seen a bit of a cleaning of the markets by the central bank. We also saw the central bank saying, look, have different capital if you want to engage in banking and non-banking, and you may just have to sell off, dispose of. We've seen tenor limit on CEOs of banks as well. Yeah, single obligor limit. It looks like the last 10 years or less than that has been really, really profound in terms of what the central bank has done in terms of regulation. You think those things have helped now begin to remoderate, reconstruct the behavior pattern of investors in terms of their outlook, their perception of when to buy, when to hold, and when to run?
Well, regulation is very important, but another key thing also important to the markets is also macroeconomic volatility. So when you're investing in a market, you're not investing only because you have a good assessment of a company's corporate governance. You also have to look at the company in terms of the economic backdrop. Is the economy growing? Is the foreign exchange market stable? Does it permit ease of entry and exit of foreign investors? And while the risk of corporate governance and risk management has reduced in the Nigerian market over the last 10 years, we have seen the risk of macroeconomic volatility also increase as well. Because of Nigeria's, like I've always mentioned, because of the close correlation of our business cycle, which was happening in the oil market, right? So you will see that the decline we saw in the market between 2014 and 2016, it was majorly driven by the macroeconomic volatility in the market.
The risks from the macroeconomic space, and less from the regulatory side of things.
Exactly. However, like we discussed earlier, the decline in the market then also provided a very attractive entry opportunity for most investors. The way to deal with volatility is this. Number one, you have to know the type of investor you are. Are you a long-term investor or a short-term investor? That's the key for you not to be too panicked during period of volatility.
Your investment profile, horizon.
Exactly, horizon. Know who you are as an investor and know your investment horizon. If you're a long-term investor, during period of decline, if you have excess cash, that's the right time to put them to use.
Like we have right now?
Right now, that's the time to put them to use and buy stocks that you probably felt were overvalued before. So perhaps maybe you've been looking at some banking stocks, earlier at the start of the year, and you feel that the valuation multiples were elevated. But this sense pullback is also, an entry opportunity for you to buy the dip and re-enter these stocks. But that is if you have a long-term
I'm not sure
investor.
we have the whole time here to teach folks how to calculate